276,000 American homes just entered active foreclosure. That's the highest number since February 2020. And Intercontinental Exchange Mortgage Technology, the company that processes performance data on more than 2/3 of every U.S. mortgage in the country, says foreclosure starts are now climbing 26% year over year. That's why today we're covering the biggest foreclosure pipeline build since 2018, and why the data confirms it's just entered phase 2. Here's what's coming. First, there's a single policy change that took effect on October 1st of last year that nobody outside the mortgage industry is talking about. And it's the reason your neighbor, who's been working with their lender for 2 years, just got a foreclosure notice. Second, there's one specific group of homeowners holding 55% of every seriously delinquent mortgage in America right now. And if you bought your house in 2022 or 23, the data says you need to hear this. And third, there's a number, 1.1 million, that represents how many American homeowners are now underwater on their mortgages, the highest level since early 2018, the same year this pipeline build started. If you own a home, if you're trying to buy one, or if you're sitting on a property waiting for the right moment to sell, this is the data nobody is putting in front of you. So let's start with what the pipeline actually looks like right now. As of the April 2026 first look report from Intercontinental Exchange Mortgage Technology, 276,000 mortgages are sitting in active foreclosure. That's not delinquent. That's not in trouble. That's the legal process has started, up 32% from 1 year ago. And here's the part that makes this a real story instead of a headline. That 276,000 number is now above the pre-pandemic March 2020 benchmark of 271,000 for the second straight month. We have crossed back through the pre-COVID line, and we kept going. The serious delinquency number, that's mortgages 90 or more days past due, not yet in foreclosure, sits at 577,000, up 101,000 in a single year. That's a 21% increase. Stack those together, and 878,000 American mortgages are either seriously delinquent or in active foreclosure right now. To find a higher number, you have to go back to June of 2018. The title isn't dramatic. The title is conservative. Now, compare that to 2018 itself. In 2018, the entire year produced 576,000 foreclosure starts. That was an 18-year low. Active foreclosure inventory had fallen below 300,000. The system was working off the last wreckage of the 2008 crisis, and 2018 was when the smoke finally cleared. We're now sitting on top of that 2018 marker again, climbing. But this is not 2008. I want to be very clear about that because the housing channels that scream crash every 6 months have made it impossible to have an honest conversation. At the peak of the 2008 crisis, 3.7 million American mortgages were seriously delinquent. Active foreclosure inventory hit 2.2 million. Today's 276,000 is roughly 1/8 of that peak. Conventional and government-sponsored enterprise loans, that's your standard Fannie Mae and Freddie Mac mortgages, sit at 0.55% serious delinquency, near record lows. This isn't a systemic credit collapse. This is something narrower and in some ways more interesting. And that's what Phase 1 was. Phase 1 started in 2023 and ran through the third quarter of 2025. It was built almost entirely on FHA loans, Federal Housing Administration mortgages, the kind first-time buyers use because they only require 3.5% down. The Mortgage Bankers Association reported in February that the FHA delinquency rate hit 11.52% in the fourth quarter of 2025, highest since the second quarter of 2021. Marina Walsh, the MBA's Vice President of Industry Analysis, said it directly. FHA loans originated in 2022 and 23 are performing dramatically worse than loans from 2020 and 21 because that's when mortgage rates spiked and affordability snapped. Those borrowers bought at the worst possible moment with the thinnest possible margin, and now they're trapped. That's because of equity. Intercontinental Exchange Mortgage Technology reported in February that more than 1.1 million American homeowners ended 2025 underwater on their mortgages, highest level since early 2018. And the concentration is brutal. Nearly 70% of FHA loans originated in 2023 and 24 in Cape Coral, Florida, are underwater right now. 65% in Austin, 57% in Northport, These borrowers can't sell at par to escape. They can't refinance. They can't walk away clean. They're pinned. That's phase one, the buildup. Tens of thousands of borrowers getting deeper underwater, falling further behind, but never actually entering foreclosure because the federal government had a program keeping them out. If this is useful so far and you want the next video the moment it lands, subscribe and hit the notification bell. We do this analysis with primary source data, the actual reports, the actual policy documents. No clickbait, no speculation. Bell on means you don't miss it. So here's Phase 2, October 1st, 2025. The U.S. Department of Housing and Urban Development implemented Mortgage Letters 2025-12. The letter killed three things. First, it ended the COVID-19 Recovery Options Program, the lifeline that let financially distressed FHA borrowers get a partial claim plus a modified mortgage with almost no documentation. Gone. Second, it killed FHA HAMP, the Legacy Modification Program. Gone. Third, and this is the one that's actually driving the foreclosure starts, it imposed mandatory 3-month trial payment plans before any borrower can be approved for a permanent modification. And it capped borrowers at one permanent loss mitigation option every 24 months. The old rule was 18 months. So now if you fail your trial payment plan, you're out, and you can't try again for 2 years. The mortgage industry knew exactly what was going to happen. Donna Schmidt, the CEO of DLS Servicing, said it to American Banker in May. Her words, "I expected to see 5 years of normal foreclosure activity get condensed and forced through the system in the next 2 years. This is just the start." Ron Malik, who runs default operations at Dovenmule, one of the largest mortgage subservicers in the country, said it even more directly. "We've reached a period of exhausted loss mitigation and there's no more to give. And then, we know with a high degree of certainty that the inventory will continue to rise." The data backs them up. The April 2026 Mortgage Monitor from Intercontinental Exchange Mortgage Technology reported that cure rates, the percentage of delinquent loans that get back to current, have collapsed more than 40% since the third quarter of 2025, and roughly 70% among FHA borrowers specifically. 70%. The loans aren't curing anymore. They're rolling forward into the pipeline. And once again, wait, it gets worse. Adam Data Solutions reported in April that completed foreclosures, actual bank repossessions, REOs, were up 45% year over year in the first quarter of 2026. 45%. The pipeline isn't just filling, it's emptying out the back end. And here's the controversial take, because this isn't an accident and it isn't a recession. The foreclosure wave we are now watching wasn't caused by a job market collapse. It wasn't caused by an interest rate spike. It wasn't caused by a credit shock. It was scheduled. For 5 years, federal policy let financially distressed FHA borrowers, the words of Ted Tozer, who ran Ginnie Mae for 7 years and oversaw nearly $1.7 trillion in mortgage-backed securities guarantees, let those borrowers kick the can down the road as far as forcing borrowers to deal with the inability to make their mortgage payment. In October 2025, Washington picked the can back up. Phase 2 is the bill for a backlog the federal government deliberately deferred. If that take pisses you off, or if you think it lets the borrowers off too easy, or if you think it lets the government off too easy, drop it in the comments. We read every one. And make sure to hit the like button while you're down there, because YouTube doesn't show this kind of analysis to people unless you tell the algorithm it matters. Here's what this means for you, depending on where you sit. If you own a home, particularly if you bought between 2022 and 24 with an FHA loan, particularly in Florida, Texas, or any other Sunbelt metro, you're in the exposure zone. Run the numbers on a $350,000 FHA loan originated in 2022 at 6.5%. Your principal and interest payment is roughly $2,212 a month. Under the old COVID-19 recovery modification, a partial claim plus a 30 or 40-year modification could have cut that to roughly $1,659, about $550 in monthly relief with almost no paperwork. As of October 1st last year, that option is gone. You get one shot at a permanent modification. You get a mandatory 3-month trial first, and if you blow the trial, you're in the foreclosure pipeline. If you're a buyer, this means distressed inventory is going to slowly grow over the next 12 to 18 months, particularly in Florida, Texas, Indiana, and South Carolina. The states Adam ranked at the top of foreclosure rate increases in the first quarter. Not a flood, a trickle that widens. Watch the REO numbers in your specific metro. If you're a seller, this is a comp risk. Distressed sales drag comps down, and in markets where Intercontinental Exchange Mortgage Technologies data already shows price declines, Cape Coral, Austin, Lakeland, San Antonio, the comp risk is real right now. The last time the system tried to digest a backlog like this, 2018. It took the housing market the entire post-crisis decade to clear. The difference is, we're not clearing wreckage from a crash this time. We're watching the slowest motion foreclosure event in modern American history. Scheduled by federal policy, executed on a calendar. There are 4 data points that will tell us whether this becomes Phase 3, meaning whether it escapes the FHA box and starts hitting conventional borrowers like you and me. First, conventional and Fannie, Freddie serious delinquency rising meaningfully above 0.6%. Second, REO inventory swelling enough to pressure comps in major metros. Third, early-stage 30 and 60-day delinquencies turning positive year over year. They're actually down right now, which is the cleanest all-clear signal we still have. And fourth, negative equity spreading beyond the Sunbelt into the Midwest and Northeast. Until one of those 4 flips, this is still Phase 2. But Phase 2 is enough. 276,000 families are already inside it. Subscribe and hit the notification bell so the next video lands in your feed the moment it drops. And watch this one next. We'll see you next time. Need a voice for your next audio or video project? Commercials, narrations, e-learning, and more. Professional voiceover services are just a click away. Reach out to the channel today.